righty. Yeah, people I'm sure will join as we go.
If you
Thank
do
you
want to
for.
start, I can let folks into the lobby. I'm from the
Oh,
lobby.
excellent. All right, great. Um, okay, well, appreciate all of your time and being conscious of your time. We are going to get rocking and rolling. Today, we're going to focus on taking that snapshot of what our world and financial world looks like at the moment and building out a financial statement. So I'm going to go ahead and share my screen and be underway. Do slideshow. All righty. And Barry, you see it all right? Excellent. All right. As I mentioned, we are discussing the ABCs, and you will see why we call it the ABCs of net worth here in a moment. My name is Jedediah Collins. As always, appreciate the collaboration with MN Custom and excited to talk to you today. So, what we wanted to begin with is a real kind of framework around what the difference between being rich and being wealthy is. I would ask, you can drop in the chat or somebody can unmute. Give me your definition of what being rich is. What does rich mean to you? I got a couple confused looks. Bari, can you kick us off? If you could give me a definition of what being rich means.
Um, I don't know, that's tough. I've never been asked that, but I think maybe having the money to do what you want to do,
I like it. I
or
have the
like
money today to go and do what I want to do. That's a great definition. That's perfect.
maybe a
Let's
little
leave that.
excess, but
All right. Little excess. There you go. So I can do what I want and I have a little bit of excess. Ryan, if you could jump on, what do you think wealth means? What is the difference between rich? Now that we see a definition of that, how would wealth differentiate?
uh, say wealth would be more substantial than that in terms of I don't know, having money but not necessarily have it liquid assets, investments, all that kind of stuff. Just building up your portfolio there.
Perfect. Anyone want to jump in on that? Building up assets, having a bigger portfolio. Anyone else have a definition? All right, I saw Joey move, but we're going to go into what we define. As we look at this idea of rich versus wealth, we have to have this conversation because as we measure our net worth, it is going to become a question of, well, am I rich today or am I wealthy in my future? And as you can see on the screen, we at Money Vehicle define being rich very similar to how Bari mentioned it, having money today. I have money today to do what I want. Where we start to shift over to that idea of wealth is where we start to look at how many tomorrows do I not have to worry about money. So rich is a snapshot of today, wealth being a snapshot of more a measurement in time. And I really like this differentiation. Your net worth is going to be measured in dollars today. But when you start to look at what wealth means, well, that differs for everyone else. Somebody in the fire club trying to retire early, maybe spending $2,000 a month, is going to be wealthier than somebody who is spending $22,000 a month. So as we look at this measurement, we had to begin with that definition of rich versus wealth. And now we understand our net worth is going to be measured in dollars, but by the end of this session, we're going to be able to translate that to time for you. The equation for net worth, very simple, very straightforward. Assets minus liabilities equals your net worth. And so as we get this fundamental formula, fundamental equation, this is accounting 101, if you will, we start with every great journey. Where should a great journey begin? And in no simple terms, we're going to begin with the end in mind. That is where every great journey will begin. Your net worth, your financial journey is no different. So as you look at this net worth statement, it is going to walk through the ABCs of your net worth. And how and where are we going to begin? Most would say let's begin with A. That's not where your financial journey begins. Your beginning starts with that end in mind. So we are going to look at what this ending net worth number is. That F stands for your freedom. If you wanted to take a moment, blank piece of paper, and just draw out A, B, C, D on your left, E, F, G on your right, this is what we're going to do today. We're going to build out your net worth statement. Starting with that F number, I'm going to ask you, challenge you, and again, it is just a pie in the sky, high ballpark number. What is a dream net worth for you? You know, I get to talk to and present to different audiences, looking at you as professionals today. Is there a net worth number that you've started to think of as that's a freedom number for me? Later this week, I'm going to be delivering to NFL players. Very different kind of beginning of their plan, but similar strategy in can you identify what that number is? Write down a ballpark number just for the moment. We're going to circle back to that throughout and then dive into it at the very end. But it begins with this mindset that you are driving, you are setting these goals. Now you have at least something that many of you probably never even thought of. What is that number for me? Do I have any idea how that relates to me or my personal plan? So now that we have a destination, let's begin with the basics. That A is going to be where your automations are set up. We've talked about before the money bucket system. I'm going to show you those here in a moment. But beginning with your bank accounts, where is your checking account? Where is your savings account? Do you also have a high yield savings account? Do you have multiple accounts at different banks? Are you also receiving some kind of 1099 income? If you are, you should have a separate savings account for a second income source where you are going to target your tax liability in that savings account. Working as a W-2 employee, my employer helps me pay my taxes. If I do have any secondary income that is non-employee 1099, I'm responsible for my own taxes. And so setting up a separate savings account for that tax liability is going to be crucial. As we saw very recently, one of the questions that I get now around these bank accounts is, are they insured? We all saw Silicon Valley Bank have some struggles in the recent past. The question of how much does FDIC cover? $250,000 per account. If you've ever heard of Giannis, the Timberwolves NBA player, it is reported that he has 50 bank accounts because he has no more than $250,000 in any of them. I don't think that is a necessary step. It is a funny example, but as you look at your bank accounts above that 250,000, that is at FDIC with a bank. Credit unions have the same protection through a different source called the NCUA. Same $250,000 though. So are you protected from a quote unquote bank run up to $250,000? Absolutely. And then the big question of these, that automation. How am I automating? How am I connecting these accounts? Is my paycheck going into a checking account? Is it going into a savings? Perhaps it's going into a brokerage account, which we'll talk about in a moment. But then how much is being passed into my day-to-day spending? How much is being passed over to my future choice? How much is being passed to my bills? These accounts are where you really make your choices before the checks even come in. How can you automate these? Last but not least, as we look at our bank accounts, you should identify your account titling. Have you recently come into a family relationship? Have you recently been married? Have you recently separated? Who else is on the account? And what is it titled as? Joint tenant by entirety, joint tenant with right of survivorship. They're kind of funny terms, and there's not too much we need to dive into this. But if you list out your accounts and just simply write how they are titled and where and how they will pass, you'll have a clear definition of where your dollars would go. And that is the beginning basis of an estate plan. I have $82,000 in a savings account. Is anybody else's name on that account, or is that going to go through my will? You can identify those things by looking at how those are titled and who and where they are headed. I mentioned that money buckets. I'm not going to spend too much time as we have done this in other sessions, but those 5 choices, each one of them can be automated through the accounts that we were just discussing. And as we look at building out our habits, what we want to get to is the first of each month, or whenever you get that paycheck, percentage is going to your future. That is our priority. Begin by paying yourself first. We call it automate. The 8th of each month, let's identify those past choices, those debts, those bills and subscriptions that, again, we can begin to automatically pay. The 14th, 1% for someone else. 25th, as I mentioned, for that tax liability. And then with this system, and what I love is identifying that last pass as an enjoyable treat yourself day. Rule number 2 in one of our action items is going to be calculating what is my month-to-month burn rate? How much money do I live on? That's my past and present choices. And then looking at how I can start to automate my systems and automate my buckets. As we started in that top left category, we started with this spender mindset. My checking account is my spending account, and it is intended to do so. We ventured into a savings account. As we look at inflation today, saving is no longer going to be enough to achieve that freedom number that you wrote down. Saving is an important and vital first step, and we do need what we call the Corona cushion, or previously the emergency fund. But the challenge here is to venture into this third mindset of becoming that investor and truly making our money go to work for us. Where does that begin? That is going to be in your B brokerage accounts. So as we look at our bank accounts being set, automated, now we're dropping down where money begins to create more money. Savings account, good, but it is just going to keep up with inflation. It is not going to generate and create. That's where we have to take that risk of becoming an investor. This is going to be an individual brokerage account. This is going to be some kind of new technology application where you are investing your money. But the first question you're going to ask about these accounts as well is which bank account is going to be connected to them. I have seen, and I personally use, my portfolio paycheck, where my paycheck does not go into a checking account. My paycheck goes directly into my brokerage account. Why? Because then I am automatically paying myself first. From that brokerage account, I then pass to myself my burn rate, or our monthly usable number, and allow that automation to make sure, without budgeting, without checking, without anything, I know how much and where my spend is going on a month-to-month basis. This brokerage account is going to begin to introduce you for how much risk you're willing to take on. As you see that number grow, as you know what's in your bank accounts, you're going to be able to identify, okay, I now have $20,000, $50,000, $100,000 in this brokerage account. I'm comfortable putting some in a more lower risk investment. And as that number grows, I'm able to start taking some more risks as my portfolio, or as this account grows with it. So as you look at this brokerage account, you're going to be able to identify, I have to start taking risks as I become an investor. As I transition and start to look at it from a large perspective, now I'm going to be able to identify how much risk I want to take on and where exactly do I want to take that risk, because we have more accounts coming up. Last thing I wanted to say about the brokerage account. Your brokerage account is going to be taxed twice. Not a terrible thing, but it is a traditionally income tax. So I made income, I got taxed. I then put those dollars into my brokerage account. Once they're in my brokerage account, it's going to grow, grow, grow. And then as I take the dollars out of my brokerage account, I get taxed on them again. The beautiful advantage of brokerage accounts is your dollars are accessible anytime and any place that you need them. The disadvantage is that they are going to be taxed twice. So you have to be able to measure, how do I build this portfolio? How do I put into my brokerage? And then how much do I want to transition into a different type of account? I love this example because it gives you a very clear understanding Now that I am entering into the brokerage world, I have to take on risk. I have to identify how I'm going to begin my investment journey. Money Vehicle is a very clear, very simple investment philosophy, and it mirrors to who is going to win the 20. I got to update this slide. Super Bowl has passed. The 2024 Super Bowl. You can have a choice. Us being located in the Northwest, let's say the Seattle Seahawks are going to win the 2024 Super Bowl. Then somebody comes along and says, well, that's just one team. What if I wanted to bet on 4 teams? Well, that is a division. So somebody could say, I want the NFC East. Seahawks are over here by themselves. A division of 4 teams is over here. And so I can bet on 1 or I can bet on 4. Moving our way up, if you say, I don't want to bet on a single, I don't want to bet on a division, I want an entire conference, or better yet, everybody in the NFL. This is where we get introduced the concept of index funds. No longer are you stock picking one by one. You're not even choosing a mutual fund 4 by 4 or 10 by 10. Looking at an index fund and saying, I am willing to take on the risk of the market. I'm going to be average and accept the return of that market, and I'm going to use an index fund. Not investment advice, just education and guidance. But if you were to look into, okay, I get index funds, I want to put them into my brokerage, which ones should or could I start with? QQQ. I believe technology is kind of the future. That is 100 technology-based companies. QQQ is an index of 100 technology companies. Again, maybe the future, may not be. It is going to be high risk, high reward, depending on how the tech market does. Well, I don't want to just be in technology, even though it's super cool. I want to get bigger than that. VOO is going to be 500 companies called the S&P 500. Those are the 500 largest companies in the United States. Pretty good bet. If you looked at it over the last 100 years, those 500 companies have done extremely well. If you were to bank on the next 100 years, I would hope those 500 companies are still doing really well. Another cool tool about an index is the idea that it filters itself. Company 500 on the S&P 500 is going to be removed once company 501 gets bigger than it. So it filters itself and it remains the top 500 in the country. RUA is called the Russell Index. They have 1,000 or even 3,000 companies in those indexes. Last but not least, people say, I want something global. I want the biggest index there is. Vanguard offers a 9,000 company global index. Is that going to skyrocket up overnight tomorrow? No. Is it going to be a pretty safe and secure investment over the next 10 to 20, 30 years? It should be, because it's the global economy. So as you look at the power of an index, I'm starting in my brokerage account. We're going to talk about 401ks in a moment. I'm starting in this. I got to take the risk. I don't know where. Be average. Give me 100 tech companies, the 500 in the United States, 3,000 in the United States, or all the way up to 9,000 globally. Those are very solid areas to begin your investment journey. Questions, thoughts on brokerage accounts, index funds, and how to get started in that environment for that account? All righty. As we know, putting it into the brokerage, putting it into an investment is making our money go to work for us. So as we employ our money, you are the CEO, you are the operator. You say, I want my employees to go to work for me. This is where you're going to begin to do that. The challenge always, begin with that end in mind. What percent of each paycheck am I going to designate and put towards future me? So we started with the end in mind. We then automated some of our choices. We started to employ our paycheck and put money into that brokerage. What comes next is where a lot of people see wealth develop, wealth creation. This is going to be a conversation and an understanding that we are going to look at both, I call it C company accounts, or D, dirt. You can, kind of title these or talk about them any way you'd like. But as we talk about those retirement company accounts, those are going to begin with A, your company benefits. Do I have a 401k? Do I get a 401k match? Yes, is my health insurance and other benefits a part of this, but those aren't going to show up on your net worth statement. Right now, you are just looking at your investable company accounts. So that 401k is going to be a big ticket item. In that 401k, can I use that same philosophy of an index fund? Absolutely. You can utilize that B average index mindset in any investment lane. Your 401k with MN's options is going to be a good place to start. But I've maxed out, or I like my 401k, but I don't want to solely be there. Or I have some other accounts from former employers. These are where those individual accounts, individual retirement account, IRA, 401k, I'm a W-2 employee working at a company. IRA, I either have former employers, I have 1099 income, I have other avenues that I want to start putting to work for me and protecting. So I can have this option of an IRA, a traditional or a Roth. We're going to talk about those two here in a moment. But can I put into a 401k and then put into an IRA? Well, if this IRA is a Roth, the answer is yes. We have to talk about taxes and you have to discuss with your CPA, but the opportunity to do something like that is available. Can you identify and look at and say, well, I want to max out my 401k and I'm not ready to do this over here, but I still, that's your decision. I would make sure you get your employer match maximized first and foremost. That is a no-brainer. That is a first start. But as you start to build out these other benefits and other plans, you can see how you can strategically start to add to each of them, even start to invest differently in them. And I'm going to speak on that here with the Roth in a moment. This company account could also be some kind of investment. Do I have ownership of any individual company? Do I have a side project, a side hustle? If I started an LLC as an entrepreneur, those are all going to be categorized under those retirement accounts for those initiatives. Looking at this, you're building out where your statements are and where your accounts are held, how they are titled, and then how much are in each, because you're trying to add up my assets and then we're going to net out our liabilities. So as you look at that LLC, am I a part owner? I bought a duplex a couple years ago. That's in an LLC. That would go under those accounts. I had a friend come ask me for $5,000, got a couple percentage of his startup. That's going to go into that category. Looking at what other avenues you have for ownership and for building, that's going to be a big key element to looking at what is going to be in those accounts. And then we call it dirt because our primary asset is usually going to be our home. So we own dirt. That is going to usually be where most people's personal assets begin. When you look at a car is an asset, does have value, but we're going to talk real quickly about what a depreciating asset looks like and even what good debt looks like in leveraging. But as you start to add up those personal assets, make sure jewelry could go into there. Any kind of intellectual property could go into there. Anything that has a value that is a part of you and what you own is going to be in that personal category. Where we look at wealth statements and net worth statements, these two are going to be where a lot of your dollars are going to start to accrue. Why? Because these primary assets, real estates, or these retirement accounts with the tax advantages is going to be where people traditionally want to earmark and target how their money is growing. We talked about that 401k versus a Roth IRA, pre-tax versus the Roth. 60 seconds to update and just kind of cover again what those mean. Pre-tax means I want that tax advantage today. It's going to deduct or reduce my taxable income, and then I get the opportunity to have tax deferred growth. I put $10,000 into my 401k, it became $20,000. I don't have to pay taxes on that 20,000 until I use it later in my life. Then the government's going to say, great, you haven't paid income taxes on these dollars. We're going to make you take them later in your life. Hopefully, you'll be at a lower tax bracket then because you're not traditionally working. And then those distributions are going to be taxed as income. So you do get the tax deduction today, the tax deferred growth, and then you are taxed on your 401k or traditional IRA dollars. When we look over at the Roth side of the equation, we start to see, well, these are going to be taxed today. I get no benefit tax-wise today for putting my dollars into a Roth IRA or a Roth 401k. What it does from there is give you a tax advantage for the rest of your investment horizon and the rest of your life. So again, no effect on your current tax liability or current taxable income. But as you look at growing, none of your growth, none of the dollars when you distribute will be taxed. So if I have $20,000 in my Roth account when I am 72 and I'm pulling dollars out, it is tax free. Another unique part about the Roth, if I were to pass a Roth account from me to my children or to someone else, those dollars are already taxed, so they will therefore, again, not be taxed. When you look at and say, well, I want to put money into a Roth 401k, but I want to get that 401k match, your 401k match will always be pre-tax. That has to do with how the company is designating it, being held responsible and taxed on it. So any any match dollars will be in that pre-tax. And then they will always grow either tax-free in a Roth or tax-deferred in a traditional 401k. Before I move on, because that's a lot of nuances, any questions on that pre-tax to Roth? Where people start to make this transition is looking at their income tax bracket. What is your marginal or next dollar going to be taxed at? If I'm in the 30s percentages, maybe I want that tax break today. If I'm earlier in my career, maybe I'm comfortable getting taxed on it and then putting those dollars to work. But it's a personal decision with a couple variables.
Jed, I've got a couple 401ks from past employers, nominal amounts, nothing crazy.
Okay.
Was curious if you could talk about backdoor the 401ks into Roth and catches or gotchas or, pitfalls maybe.
Great question. So I have a couple 401ks from past employers. First off, let's simplify. Let's combine those into, obviously, when you leave a 401k, usually they will make you distribute and you got to put it into a IRA. So they're calling it a rollover IRA. I collected 3 different 401ks into a rollover IRA. The question around a backdoor Roth conversion. This is not the traditional, I am making a Roth contribution. With a Roth contribution, you have income limits. If my income is a certain amount, I believe it's in the $170,000, I am no longer able to directly contribute to a Roth account. This is where the backdoor Roth consideration comes from. It is technically a tax loophole, but it is one that if you understand the game, you understand how to process, it is available to you. What you do is you make a non-deductible contribution to a traditional IRA. I have a traditional IRA with no other dollars in it. That is where I'm going to get started. I cannot move any of the earnings. It has to be the contribution that I did not get a tax deduction for. But as long as those dollars are in there, I am then allowed to backdoor and push them into a Roth IRA. They've already been taxed. I'm not getting a tax deduction, no tax advantage, but they're in a traditional IRA or rollover IRA. And then I push them directly into a Roth as a backdoor Roth conversion and contribution. So if you were to look at it and say, I have a pretty good size 401k with pre-tax dollars, I want to start building my 401 or my Roth side, I could take my rollover IRA or my old 401ks, get them into that account and then backdoor them into a Roth conversion. If they had not been taxed to do that, you're going to have to accept the tax income, or excuse me, the tax liability today. But as you look at this balancing act, it would be a great strategy and a good move. If I'm comfortable where my 401k is and it is bigger and growing, making some of these conversions, accepting the taxable amount, and getting them into that Roth IRA. It is a simple process, but it does take that step of I have to have it in an IRA and then backdoor it into the Roth. Joe, I hope that answered your question.
It does. May I have a moment for another question? So
That's why we're here.
If we're going to take the hit and pay the tax and put it into the IRA vehicle, the Roth vehicle, why not just pull it out, take the penalty, and put it into a brokerage account to have ultimate flexibility?
Great question, because you are assuming those dollars are going to have earnings and they're going to go up. And so if it is in that Roth account, I put in the 10,000 in a Roth, I put 10,000 in a brokerage. As they grow, brokerage is going to tax you again. Roth is not going to tax you again. So that would be the advantage of having it in the Roth account.
So the yearly capital gains on the brokerage account versus
Yes, sir.
Totally tax free, basically. Okay.
Totally tax-free. And the advantage of the Roth over a traditional is there's no going to be automatic distributions. With a 401k, with an IRA later in your life, the government's going to say, I want you to take those dollars out. I need my money. With a Roth account, there's no mandatory distributions or withdrawals later in life. But yes, the Roth advantage over a brokerage account will be the tax-free growth.
Thank you.
Hey, thank you, Joe. Appreciate the question. We all learned a little something.
Hey, Jed, can I
Yes,
ask
sir.
a quick question about IRAs?
Absolutely.
Assuming you can't contribute to Roth due to income and you want to contribute to an IRA, maybe in addition or in lieu of a 401k program, how can you contribute to an IRA on dollars that have already been taxed based on income? You know what I mean? Like if I
Yes.
get a paycheck, pay taxes on that, and now I'm contributing to an IRA, which is meant to be pre-taxed money.
So it's called a non-deductible contribution. So you'd still go into that traditional IRA, but you would call it a non-deductible contribution, meaning I'm getting no tax advantage today, but with this non-deductible contribution, I'm putting money into this vehicle. From there, you can do the steps we were talking about with Joe of possibly taking another step into a Roth IRA, but you can contribute dollars after tax as a non-deductible contribution to IRA.
If you did go the backdoor route with that, is that actually easier to do because you already paid taxes on it, or how does that work?
Easy is relative, but it
Yeah.
is advantageous. Absolutely. If these dollars are net income, they have already been taxed. The government is happy. Now it's just where do I want those dollars to grow? Taking the step into a non-deductible IRA and then getting into that Roth IRA is going to allow you the best advantage for those dollars to grow into the future.
Cool. Thank you.
Hey, great questions. Okay, as we shift now, we're talking about that dirt, about those investments, those assets, and we had to look at what a depreciating asset is versus what leverage is to get an asset. So as we look at depreciating, we don't want to dissuade or go away from all these types, but if you were to look at a quote unquote bad asset, it would be one that depreciates. The great example and the easy example is your car. You drive a car off the lot, it immediately depreciates in value. That's not a good asset. That's not a good investment. A lot of our assets will depreciate. There are some tax advantages, but you really want to see an appreciating asset to be defined as a good asset. On the flip side of that, when we start talking about liabilities, people see good debt, good liabilities, and they start to look at this word leverage. Working in the home space, nobody has $1 million in cash to go buy a house. So they put a percentage down and then they go and get good debt to go buy their house. But we have to be able to measure the risks and returns of these. And that's something that we're going to talk about here in a second again. But this idea of a depreciating asset, meaning it is losing value as I own it, and an appreciating asset, and then leveraging using dollars that are not yours to go and buy more. Using dollars that are not yours will always come at a fee, come at a cost in interest, and you have to measure the return of that as you move forward. So our rule number 4, open that Roth, get those tax-free dollars to work for you, and then begin to measure your good assets or your bad assets, and then your good and bad debt as you move forward. So now we are going to flip to that other side of the formula. We looked at our assets. At the bottom, you will look at your total assets. I have X number of dollars as my assets, but we have to net out these liabilities. So we look at the where people get a little uncomfortable around debt. So as we flip to that, you start to measure, who am I paying? Whose money am I using? Maybe I have that primary home. Well, now I have to have a primary mortgage. I bought a car. Well, now I have an auto loan. Did I buy the car in cash? Is that a good investment from a depreciating asset? That's a conversation for another day. Do I still have student loans? Always one that remains on people's balance sheets in net worth statements. Credit cards. Not going to go into those too much, but as you identify, credit cards are in the 20% interest rate. No reason to carry a credit card balance, so make sure you get those paid off. And then the home equity line of credit. Very good tool, very hard to achieve today. The banking systems, a lot of people have pulled away from offering HELOCs because they see it as too much leverage as the housing crisis, different changes have been made. But if you can access a home equity line of credit, it is a worthwhile leverage and tool because it is equity you have earned on your primary residence in your home. So those are just quick lists of types of liabilities and types of debts. Those are going to be personalized to you. But as we start to identify this idea of credit, I wanted to give you a quick overview of your financial reputation, your credit score. This can be an hour-long presentation in itself, but what I wanted you to see is how your credit score, which everybody from, if you rent an apartment, get insurance, go and ask for a loan, everybody sees as your financial reputation. The primary measurement is going to be, have you missed your payments? Have you been late? Have you been missing? What is your credit payment history? We want to be able to make sure you are going to be trustworthy. How close are you, or how much of your credit are you using? If you are maxing out how much of your credit you're using, more creditors aren't going to say, hey, that's good, we want them to use more of ours. They're going to say, they really need this. That's a red flag for offering more and more. How long you have had credit. Very many people who move to our country go, I've never used a credit card. And they are actually dinged, even though they haven't done anything wrong, but dinged because they don't have the reputation. They don't have the history. Why we challenge your students, your children, young people, start a credit card is because it starts this credit length and you'll get rewarded for it. How much are you asking? Very big difference between a soft inquiry, I'm going to rent an apartment or do something, or a hard inquiry where I'm actually asking and requesting more debt. Hard inquiries are going to be what are tracked and measured. And if you ask too often, you're going to get dinged for that. And then the funny part about this credit game is they actually want you to handle multiple types. So I have a credit card, I have a second credit card, I have an auto loan, I have a home loan, I have a student loan. They like the multiple actions. They like seeing you handle from a variety perspective. The 3 things you're going to ask about your debt. Why did I take it out? What was the opportunity? Am I going to get back more from borrowing these dollars? With my home, I borrowed money, put it into my home. The home grew. My life was good. That was worth that risk. Car, is it the same equation? That's up to you. You have to decide that. Then you look at the rate. What was the cost? Again, home, 3, 4, 5, right now, 6, 7%. Credit card, 20%. What is worth that risk? Not much. So as you look at what the rate is, see that, and again, with inflation, with prices, with rate, federal funds rate, all those, That is going to change based on the time. Right now, we are in a higher interest rate, as we all know. Last but not least is your risk capacity. Any debt you're looking to take on, even if it's going to give the potential of a great opportunity, if it's a good rate, if it doesn't fit into your plan today, that is one you got to pull back on and say, this isn't going to fit for the moment. How can I do it without taking on that risk? If it does fit within your plan, you're confident, you've automated the payments, you know where you're going and why you're doing it, good for you. And just make sure debt is your tool. Debt is not making you one. Treat that credit like a debit. Though that is the outline, that is the formula. A, B, C, D, E, F, and G. Why do we wait on G? Well, G is going to be people or things outside of your net worth. Still possibly in your calculations, considerations, but not going to be used for your freedom number that we wrote down earlier. So as we look at these are going to be philanthropic, charitable. I love the idea of donor advised funds. These are really cool tools. They're like having your own foundation without all the compliance. Donor advised fund, if you want a charitable deduction today and then to be able to use those dollars for a long time, donor advised fund is a good one. 529 accounts are for educational purposes. And then if you do start to look at and say, my family wants to put money in an account, but I don't want it to be in my name. Or I just am looking at my net worth and I'm seeing in the state of Washington, I'm over that $2 million mark. Even with my primary home, a lot of people are over that. I need, as an estate perspective, to start removing assets. That's where a trust is going to come in. Again, topic for a future session, but looking at trusts and saying, these are dollars that I could still control or I could not control, but they are no longer in my name. They're no longer going to my plan. And I want to remove them from my net worth and put them towards something else. So who will you impact with those dollars? That's why G is down in a different category. We looked at the beginning of the session, what is a tangible number? Didn't matter if you wrote 1 million, 10 million, or 100 million. I want you to get a better picture of what that number should or could be. This is going to be a very straightforward, but it is going to be a personalized formula for you to use. Take whatever monthly burn rate you want to support. That's not what maybe you're living on today. It is what you want your freedom years to look like. Maybe it's $5,000 a month. Maybe it's $10,000. Maybe you want to live it up. Maybe it's $25,000 a month. That is up to you, but that's going to be your X. My X is my burn rate, my monthly, present, and past choices. Then I look at my annual lifestyle. If I spend $10,000 a month, that means $120,000 is going to be my annual or yearly lifestyle. So X times 12 gives me my Y. That's my yearly goal, my Y. Last but not least, you simply take that number, multiply it by 25, will allow us to use that 4% kind of model. But what it will do is give you a quick ballpark number of what you need to support your Y annual lifestyle and live on a month-to-month and day-to-day basis. It is a calculation that is custom to you. I said I wanted 10,000 a month, or I said I wanted 5,000 or 7,000. I said I wanted 17,000. It is your lifestyle, it is your number, and then it will lead to your freedom. Wrapping up perfectly on time. We're going to make sure we measure our net worth. Our wealth is measured in time, in years. Can you protect 6 months? Sure, that's the first protect. Then can I get 1 year? Can I get 2 years? How many years do I not have to worry about money? As we look at actions, always set goals, not that big number in pie in the sky. What is a year goal? Today is April 2023. What can I have next April 2024? Setting a goal for this next calendar year. Find an index, be average. Make sure that money is going to work for you. I love the method of the portfolio paycheck, automating all of your accounts, depositing the dollars in a brokerage, and then distributing them from there, because you will be paying yourself first and then pay out your burn rate to that checking account. That financial reputation is going to impact all of your E category in your debt, and you are going to want to have a positive financial reputation, because that trust means people will allow you to make choices. And then as we look at tax efficiency, tax is the biggest payment we are all going to make, from our income to our estate to our sales. All taxes are going to be paid, but can you remove or reduce some? That is why we look at planning and strategy. My only ask of you is going to be possibly looking and following our social accounts at Money Vehicle. You can check out yourmoneyvehicle.com. I'm going to stop sharing and open up the door for any questions. All right, I believe Bari, you wanted to share something at the end for participation.
Yes.
right.
As promised in my email that I'd sent out, maybe some of you saw this or signed up before you saw this, but just a little incentive for coming to this session today, chance to win a $25 Amazon gift card. So I'm going to share my screen so you can see proof that this is random. 1 second here. I have all of your names on a wheel.
All right.
And
as we're looking at that, oh yeah, all right, it's already spinning.
go ahead and click it and see who wins. Must be present to win.
There he is.
Joey. Oh. All right. So I will email that to you today.
Awesome. My last request is feedback, questions. You can provide feedback to Bari. You can send them to me. Also want to know what topics you'd want covered. In that balance sheet, net worth, we talked about a lot of things and we said, that's not for right now. Wait, hey man, let's go back and let's talk about one of these. You tell us what you want to learn about. We got 45 minutes together. We want to make sure it's worth your time. Appreciate your time today. Enjoy the rest of the day, and we all got some sunshine in our future, so that's always a good thing. Thank you all. Enjoy.
Thanks, Jed.
See ya.
Thank you guys so much. Thank you.
Thanks, Jed.